Coming off the back of a week that saw higher UK inflation, we saw weakness in terms of the jobless claims data, signalling potential concerns around the jobs market once again in the US, and FOMC minutes that alluded to a Fed that's more concerned about the resurgence in inflation than the jobs market. This coming week focuses on inflation, with the core PC figure coming out of the US alongside the CPI number coming out of Australia in a week that by and large isn't huge in terms of economic data, but we should still see an interesting amount of volatility as we go forward. So first and foremost, we can see here that according to Trading Economics, the top tier items of the week kick off on Monday with the IFO business climate figure out of Germany. Then we've got the RBA minutes, which begin a focus around Australia this week. We have core durable goods out of the US on Tuesday as well. Then on Wednesday, back to Germany, GfK consumer climate or consumer confidence. Thursday to the US, it's a revision of the GDP figure. And closing out the week with a relatively busy end, focusing really on inflation. We get a couple of inflation readings coming out of the Eurozone. We've also got GDP out of Canada. But the key reading will be the core PC price index, which is the Fed's favored interest rate metric. And that's where we're going to kick off, because we've gone through a period where we've seen inflation pressures potentially start to build in terms of the CPI numbers. And we look into the underlying figures and they show that tariffs are starting to provide inflation. Then we see another CPI number, and that time around the inflationary effects had faded for the things related to tariffs. Instead, we saw areas that weren't necessarily too tariff related. Then we saw the PPI number just come out, and the PPI number suddenly starts to look very troublesome with 0.9% on that figure. And then we see FOMC minutes, the FOMC minutes essentially alluding to a Federal Reserve that doesn't seem to care that much about the jobs data, instead caring about inflation. Now, the jobs data has since weakened, so some of that commentary is relatively old in nature when it comes to the Federal Reserve. I'm sure they care more about the jobs market now than they did at the time of those comments. But nonetheless, we have seen major fluctuations in terms of market expectations of rate cuts. Most notably, it wasn't that long ago that September was absolutely nailed on for a rate cut. That's no longer the case. And markets are now pricing I think it's something in the, in the 60s. 71. Okay, so 71, if we look back, that figure was 92% a week ago. So 92% chance of a rate cut in September down to 71. So we're seeing a shift in terms of those expectations. It's not necessarily guaranteed anymore. And this coming week should give us a lot of information for that. Now, certainly there's grounds for concern when it comes to the Federal Reserve around inflation. I've said this all along, yes, we can see some weak payrolls numbers, but that doesn't necessarily mean that the inflation side of the story is null and void and irrelevant. And therefore, if we did see a surge in terms of inflation pressures, it points towards that overwhelming confidence of rate cuts from the Federal Reserve being somewhat misplaced, and we're starting to move in that direction. Durable goods, and crucially the core durable goods data coming out on Tuesday. That's going to be a big one in terms of activity, economic activity in the US at the moment. Expectation for the durable goods figure of minus 2.5, but also a negative reading for the core durable goods expected at minus 0.4. But like I said, the key reading of the week is going to come out on Friday. The core PC price index expected to drop down to 0.2% for the month. Whether that happens remains to be seen. But certainly as we look into that figure, we can see that by and large, the core PC price index figure has been in the twos and remained largely flat for some time yet. We haven't necessarily seen a major pickup in terms of that inflation metric. So where are we going to stand this time around? If we're talking about markets expecting a 0.2 reading, that's largely in line with the headline CPI figure that we saw last time around. You can see in the middle bar that the July figure for the CPI number is out. The core PC doesn't come out yet, or hasn't come out yet. And so we're looking at a figure close to 0.2. And that would really keep us on that same kind of trajectory in terms of sort of flatlining inflation coming into play. When are we going to see that start to roll over? That's going to be a key question of note, really, as we go forward. Now, in terms of the annual figure, I just want to bring that up just quickly on my own screen. So we didn't have it on there. So 2.8 expected to remain at 2.8. So it's a lot of nothing, not necessarily nothing, but certainly in terms of the movements of the figures, it's not necessarily huge what's expected by markets. But of course, there's still going to be that same focus in terms of people drilling down into the data, trying to gauge exactly whether we're seeing tariff-led inflation coming into play for certain elements of this inflation gauge or not. Now, the fact of the matter is that markets care about what this does in terms of Federal Reserve action or inaction. And there is a fear that the core PCE figure could start to rise because we've seen that across a number of different metrics. As we can see here, the ISM services and ISM manufacturing prices paid elements, if you put that 6-month lag on to show that a lot of the time it takes a while to feed into consumer prices, you can see that it does point towards the potential for a surge in terms of the core PCE price index, as highlighted by this chart. We can also see from this chart that sharp move higher in terms of the PPI figure, the core PPI figure 0.9, the headline PPI figure 0.9. So a massive monthly reading. And so that points towards the potential for that resurgence in terms of price pressures coming into play. Now, this is the sort of shift we've seen over the course of the past week, most notably, where we're seeing people pricing out the chance of 3 rate cuts for the remaining 3 meetings, moving more towards the idea of 2 rate cuts or 1 rate cut over the remaining 3 meetings. That, of course, has had an impact on markets, and I wanted to show you gold for this one and highlight exactly how this can impact sentiment and price action for that precious metal. Let's just jump into the chart. So first and foremost, what we're looking at here is the gold chart on a daily time frame, right? Now, if we're talking about market expectations for where rates are going, there's different ways of being able to do that. One good way to be able to do it is look at short-term yields in the US. So I've got the US 2-year yield, and what I've done here is that I've inverted it. So by inverting it, it's relative to the correlation that you have with gold, because essentially, from my mind, if we expect to see additional rate cuts coming into play, that's good for gold. And therefore, a weaker US 2-year yield should be correlated with stronger gold prices. So by inverting it, we should see that relationship. As you drill down and look into the 4-hour chart, you can see exactly that. So the drifting lower, which is the move upwards essentially, because we've inverted it, means higher expected rates, and therefore dampening sentiment for gold. Now, essentially, if we are looking here, we can see that the correlation comes and goes. There's certainly periods of time where it's very close. There's periods of time where we see an inversion of that correlation. At the moment, we would say that relationship is very good. And therefore, if we see something that comes out this data that points towards people feeling confident once again of rate cuts, the 2-year yield starts to move lower and gold most likely moves higher because of that inverse correlation. So essentially, by coming out with this US core CPI inflation data, if we see it coming in relatively weak, if we see it relatively depressed, we don't see anything of note or anything concerning, then we see a potential rise in terms of gold coming into play. Now, let's get that 2-year yield off the chart and look at it from the daily time frame. We can see very clearly we're trading within a bullish trend. We can see that we have seen sideways consolidation for many months now, by and large between this sort of 32.47 up to 34.38. But just this week, we've come into support here with this trend line coming into play, with the bullish engulfing pointing towards a possibility that we've bottomed out already. Remember, half of the times that we decline, we don't necessarily come all the way down to that low. So you can see here, this pullback is set within a rebound, a sort of recovery phase. We come into this sort of area here. So could we be seeing something similar here? Are we retracing before the bulls come back into play once again? Well, let's look at that 4-hour chart once again. We can see in terms of the top end of things, we've got this descending trend line. There we go. and that's been broken. Not only has it been broken, we've also got it forming an inside trend line because it's now find support here. So the subsequent pullback, has this come into Fibonacci level? It's come lovely move into the 61.8 and the descending trend line. And so this points towards a potential bottom over the near term for gold coming into play. Of course, if we do break lower, then we'll be looking for the bottom end of this range for the bulls to potentially come back into play. But as things stand, there's a possibility that we're sort of reversing course. We've broken up through the first swing high, which was here 3345. We've retraced and found support on trendline and Fibonacci support, and therefore I wouldn't be surprised to see the bulls coming back into play. But a lot of this comes down to the data. Do we see weakness in terms of the core durable goods data, the forcing the hand of the Fed? Do we see depressed, stable inflation coming in terms of the core PCE? If that happens, then again, that could provide a lift for gold. But the inverse is also true. If we see a sharp move higher in terms of inflation pressures, then gold could be in trouble. We don't necessarily see that as a great environment for the likes of gold over the near term. But that being said, we have seen it hold up relatively well thus far. And then secondly, we have Australian inflation data coming out. We've got the RBA meeting minutes coming out on Tuesday, but then we've got the monthly CPI figure on Wednesday. So expecting to see some volatility coming into play. Now the forecast here is a move up to 2% for Australian inflation, but of course that still keeps it in a relatively healthy position. The Australian economy still likely to need a little bit of a push when it comes to the actions of the RBA. Are they expected to do exactly that? Well, you can see here in terms of inflation pressures, they have abated, dropping back down towards that 2% mark, particularly with the headline number. In terms of the expectations for the RBA, you can see this time around, markets don't expect much. Around a 30% chance, or a third, that we do see a rate cut in September. Markets instead expecting something in November. But from the inflation side of things, it appears to be relatively under control, even if we do see a tick higher this time around. In terms of the chart I wanted to look at, I was just trying to look out for interesting trends, really, different sort of chart patterns. And the Australian dollar against the Swiss franc, I think, is a particularly interesting one. This is the chart from a daily time frame. You can see exactly why I think it's interesting. The trend is very bearish. Let's look at it on the weekly. Look at that, lovely trend, right? So that's the kind of market I like to trade, right? I mean, most of these candles, especially over the past few years, are red. So you have a very clear directional bias in play. Now, what's happened recently, as we can see here, is that we've sort of popped up and then broken down in the direction of that bearish trend once again. So are we now setting ourselves up for another extension towards the downside? Potentially. Certainly we've kind of still got some support to contend with, which comes in the form of, there you go, 0.5167, and that's providing support at the moment. The 4-hour chart highlights the fact that we've seen the sharp sell-off and now we're sort of swinging upwards. So you can see the potential for near-term gains for the Australian dollar against Swiss franc if we see inflation coming in particularly strong in particular. But there is room for further easing. That's what markets are pricing. And so with the SMB unlikely to act over the near term, the Australian central bank's expected to start to be cut once again. They've taken a relatively slow roll thus far, but we're expecting to see additional easing from the RBA. I wouldn't be surprised to see this rolling over and continuing that bearish trend for this chart. Keep an eye out for the 5167 low though. That level really needs to break for us to look to continue this bearish pattern for the Australian dollar against the Swiss franc. A key one to be looking out for as we look ahead to a week that includes minutes from the RBA, but also inflation data coming out at the beginning of the week. I hope that's been useful. Make sure to like and subscribe for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Thanks a lot.